Good morning, good morning, good morning. JP Morgan, they beat earnings, but they say the economy is slowing down. We're going to talk about how they're preparing for it. We have a huge deal in the grocer section. Kroger says they are going to buy Albertsons. They actually made an offer. We're going to talk about that and the impact on the grocery segment and how that's impacting other grocers like Walmart and even smaller ones like Sprouts. And then, oh boy, Beyond Meat. We just talked about them. I talked about how they're one of the worst companies to invest in, even though there's other people out there on YouTube talking about how great they are. I shared why I thought they were bad. Look at previous videos and proof of it right here. But first, transparency. Let's get into the portfolio. We have broken $100,000, which is really cool. No, it's not because of gains. We are losing money. We're down $18,000 since February 15th, 2022. We broke $100,000 because I have added $118,000 since February 15th, 2022. I'll do a full portfolio update of how all the companies are performing, how the portfolio performed over the last week in another video today, so make sure you check that out. The big story is JP Morgan is talking about how they're preparing for the economy to slow down. They're taking actions to make sure that they are prepared. When you see the headline, that's scary. That makes you think shouldn't be investing. But the bigger risk is when companies are too reckless and too careless, like in the beginning of 2007 and what led to the 08-09 financial crisis. When companies are too reckless, like they were in just the economy overall, and people just throwing money around in 2020 and even 2021. Those are the bad and the scary times. When companies are prepared and they're doing things to prepare, that saves us from having major economic breakdowns like what happened in 08-09. So we want to see these things. And by the time headlines like this are coming out that companies are preparing for a slowing economy, that's generally not the time to be selling if you're a long-term investor. That's the time to be buying because the sentiment is so negative. And we talked about this, right? The Fear and Greed Index, I've shared it in a previous video. It's not end all be all, but we are in extreme fear right now, indicated as 7 indicators that they use, and we can go through them in a future video. And so, we're not in a greedy environment, okay? So let's jump into JP Morgan's reports, and we're going to specifically talk about what Jamie Dimon said about the economy and how they're preparing. So the stock's actually up pre-market, even though they said these bad things after the bank's Q3 results topped the Wall Street consensus and said it expects to resume stock buybacks early next year. So that's one thing. That tells us that they think the stock is cheap and that they have the money to do it. The bank expects FY22 net interest income of $66 billion. Depending on market activity, excluding markets, it expects net interest income of $61.5, which compares to the previous guidance for net interest income, ex-corporate and investment bank, of $58 billion. Why is this? Because interest rates have gone higher, right? So they're going to get more interest income. Q3 earnings are benefiting from strong performance in its consumer banking unit. And this is the thing, while JP Morgan increased its provision for credit losses to brace for slower economic activity. That's the headline, right? Slower economic activity. But what we want to see is exactly what they're doing. They are preparing for it. They're increasing their expected losses, which means they're going to be smarter with their capital and smarter with their lending practices versus just lending to everybody that's anybody, which is what caused a lot of the housing crisis, among other things, in the Great Financial Crisis. In the U.S., consumers continue to spend with solid balance sheets. Job openings are plentiful and businesses remain healthy. However, there are significant headwinds immediately in front of us. Stubbornly high inflation leading to higher global interest rates, the uncertain impacts of quantitative tightening, the war in Ukraine, which is increasing all geopolitical risks, and the fragile state of oil supply and prices. He just named pretty much all of the big concerns out there, but the market has reacted to a lot of these things already. Not calling a bottom. We could go further down, certainly. But these things are not unknowns at this point, at least the fact that they're possibilities. And so in some way, this stuff is factored in, and it's not a major shock right now. There could always be a major shock that happens that no one expects. Those are called black swan events. But right now, these are on the table and people are aware of them, and they're at least trying to plan for them. So that means that some of it has been baked into the prices and some of the drops that we've seen. And I think now is a good time to be buying, which is why I'm fully invested in adding every month. Q3 earnings per share of $3.12 topped to $2.85, rose from $2.76 in Q2 and fell from $3.74 in Q3 2021. So they beat the estimates. That's a big thing. Strong quarter. They see a strong consumer right now, but they're preparing for a slowing economy. Second news story of the day, Kroger's deal for Albertsons has major implications across the grocery store sector. Essentially, they valued Albertsons at $24.6 billion. The combined company is going to have 5,000 grocery stores and rank only behind Walmart in size. Significant synergies and accretion benefits, I think that's how you say that word, from the deal are anticipated within a few years. So here's the thing. I live in Florida, and we have seen Kroger delivery is just amazing. Publix is a huge grocer down here, and they pretty much have the real estate, right? Like they're one of the most common grocery stores in terms of real estate. A lot of people are now using Kroger delivery, which they have their dedicated delivery vehicles, and the experience is so much better than when you do it through something like Publix and get it through Instacart or whatever, where they just throw it in a trunk and bring it to your house. Kroger has actual trucks that are refrigerated. They have their employees coming to deliver you groceries, and it's fresher than when you get it in the store because it's coming straight from their distribution center, which cuts out a link in the chain where generally it gets to the store and it sits there, they have to stock it, all that stuff. You're actually getting stuff faster and more fresh from these delivery efforts than if you get them out of the store in a lot of cases. And I say all that to say this is a huge strategic move because it's going to give them more footprint, more reach, the ability to run more vehicles and expand this network. And I think that it's serious for the industry. Okay, I don't own Kroger, I don't own Albertsons, but it's really cool for consumers actually, and it's a way actually to keep grocery prices affordable. Analysts think that the merger could actually support pricing across the industry, like I just talked about, including for Target and Costco, without posing a serious threat to market share for many of the major players. Investors have been looking at other grocery store stocks as well following the deal news. Got to be careful about this. Sometimes people get excited about other stocks thinking that, oh, they might get acquired, or if Albertsons got bought for this much, that means Sprouts is worth more. That can work out. It can be a benefit, but it can also backfire if people get too excited. So anyways, Sprouts was up. Ingles was up. Natural Grocers is up. Grocery Outlet is up. And U.S. Foods and Cisco also added. Okay, so just bringing the entire grocery industry up. Interesting news there. Don't own either of those companies, and I probably won't, although Kroger does pay a nice dividend from what I remember. Okay, Beyond Meat. I did a video about how bad I thought Beyond Meat was. I hate to talk bad about stocks, but I want people to be careful. But they're coming out and they cut 19% of the workforce as sales struggle. Go back to my Beyond Meat video and look at all the reasons that I said, I wasn't a fan of Beyond Meat. If I was going to own that, I would rather just own something like a Kroger or like Pepsi if I wanted exposure to the food industry. That's Beyond Meat is not how I want to get it. I don't own either of those things. People are talking about this stock, and my opinion is I would never own it, okay? Not telling anyone else what to do. That's the news for this morning. Hope you enjoyed the video. It does me a huge favor if you like the video and subscribe to the channel, and then just share it with your friends and help other people find it. I'll see you back here. We'll cover my portfolio and how it performed over the last week. Thanks.